Okay, let's unpack a real head-turner, this idea of China unleashing a kind of financial shockwave.
Right, the financial nuke scenario.
Exactly. Suddenly selling off huge chunks of U.S. Treasury bonds, other dollar assets. You sent us some fascinating stuff on this. And the big question everyone asks is, could this actually happen? And, if it did, what would that even mean for the U.S. economy, for the world?
That's exactly what we're digging into today. We've got a really insightful report here that dissects the plausibility, right, of this financial nuclear option.
Yeah.
And our mission, like you said, is to pull out the key insights, what you really need to grasp, and crucially, why most experts actually think this extreme scenario is, well, highly improbable.
Okay. Clarity without drowning in jargon. I like it.
That's the plan, aiming for clarity.
Yeah, fantastic. So let's start with what China actually holds, because the perception, often driven by headlines, is they've been dumping U.S. Treasuries fast.
That's true. If you just look at the official U.S. Treasury numbers, China's direct holdings were about $760 billion, maybe a bit more, in early 2025.
Which is way down from where they were.
Way down from over $1.1 trillion a few years back. So, yeah, on the surface, it looks like a big sell-off of U.S. debt.
But it's never quite that simple, is it? There's usually more going on beneath the surface.
So precisely. And what's really interesting here, a key insight right away, is that official figure probably doesn't capture the whole picture.
How so?
Well, we need to consider that China often holds assets through, offshore custodians. Think places like Belgium, Luxembourg, perhaps.
Hidden holdings?
Sort of.
Yeah.
Expert analysis suggests that when you account for these indirect treasury holdings and you add in their pretty substantial investments in U.S. agency debt.
Agency debt, like Fannie Mae and Freddie Mac.
Exactly like Fannie Mae and Freddie Mac bonds. When you put all that together, a different picture emerges.
Okay, so what does that picture look like?
It suggests China's total stake in U.S. bonds, treasuries and agencies combined, has actually stayed remarkably stable. It's hovered around 50% of their total foreign exchange reserves since about 2015.
50% stable.
Relatively stable, yeah. So the total figure is estimated somewhere in the $1.8 to $1.9 trillion range.
Wow. That's huge. And completely different from just a treasury number.
It is. So while headlines shout about the drop in direct treasury holdings, the real story, the key insight, is the strategic shift towards agency debt, keeping their overall dollar exposure pretty consistent relative to their reserves.
And you mentioned they're buying up agency bonds again significantly.
Yes, there's evidence of renewed significant appetite. We're talking potentially over $300 billion recently flowing into U.S. agency bonds from China.
Why agencies? More yield.
That's likely the main driver. They offer slightly better returns, a bit more yield than straight treasuries. So it suggests they still see value in holding dollar assets, just maybe tweaking where they park the money.
Okay, so China's got this massive pile of dollar assets, different types maybe, but still massive. How does that stack up in the whole U.S. Treasury market? Are they calling the shots?
Not really, not anymore. I mean, they're a major holder, absolutely. But the U.S. Treasury market is just enormous, trillions and trillions.
Right.
Total foreign holdings are around $7.6 trillion. China's slice of that pie, it's actually shrunk over time.
Interesting.
And what's also really important is the growing role of private foreign investors. It's a much more diverse pool of buyers now.
That makes sense. So why did China build up all these dollar reserves in the first place? It wasn't random, I assume.
Oh, not at all. This is fundamental. If you connect it to the big picture, these huge dollar holdings are deeply tied to China's export-led economy.
Right. They sell a lot more stuff to the U.S. than they buy.
Exactly. Which means a constant flood of U.S. dollars flowing into China. Now, if they did nothing, their own currency, the renminbi, would get stronger and stronger.
Making their exports more expensive.
Precisely. Less competitive. So the People's Bank of China, their central bank, steps in. It buys up those excess dollars to keep the renminbi exchange rate managed.
And then they need somewhere to park all those dollars they bought.
You got it. They need safe, liquid places to invest them. And historically, U.S. bonds, treasuries, agencies have been the go-to choice. It's baked into their economic strategy.
So unwinding that, selling off those assets rapidly.
It would force a really fundamental and likely very painful shift in how they manage their whole economy. A massive strategic overhaul.
Okay, so they're kind of locked in to a degree. Now, let's tackle the scary part, the market collapse idea. What if China did decide to dump, say, $500 billion in treasuries What's the immediate fallout? Does the U.S. financial system just grind to a halt?
Look, a sale that big, that fast, it would absolutely cause significant short-term turbulence, no question.
Turbulence like what?
We'd likely see Treasury prices drop sharply, which means U.S. interest rates would spike upwards.
How much upward?
Estimates vary, naturally. Some suggest a $500 billion sale could push the 5-year Treasury yield up by, say, 33 basis points. That's about 1/3%. Others see potential for much larger jumps, maybe 1.3 to even 3.5 percentage points.
Whoa, 3.5 percentage points. That would be a massive shock.
It would definitely be painful. A very significant increase in borrowing costs across the entire U.S. economy. So, yes, short-term pain, absolutely.
But you're saying it wouldn't necessarily crater the whole market, not a full meltdown.
That's the key point. What's fascinating here is the sheer depth and liquidity of the U.S. Treasury market. It's unparalleled globally. It can absorb enormous trade.
Even $500 billion.
Even $500 billion. Now, it would cause those price adjustments, those higher yields we talked about, which would actually start attracting new buyers looking for better returns. But the market itself can fundamentally handle that volume. It's built for it.
And I guess the Federal Reserve wouldn't just sit on its hands, would it?
Absolutely not. The Fed has both the firepower and, frankly, a proven willingness to step in during market stress.
We saw that in 2008.
And 2020.
Exactly, 2008, 2020. They can inject massive amounts of liquidity. They can buy assets directly, including treasuries, through things like quantitative easing, QE.
So they act as a backstop.
A critical backstop.
Yeah.
They have the tools to prevent a chaotic downward spiral, a true market collapse.
Okay, the Fed steps in. But here's something interesting you mentioned earlier.
The paradox.
Yeah. That this kind of attack could actually backfire.
It's a real possibility. Think about it. A major geopolitical financial attack creates huge global uncertainty, right?
Markets hate uncertainty.
And historically, where does money flow when there's global uncertainty?
This is safety, often.
Yeah.
The U.S. dollar. And treasuries.
Bingo. The flight to safety effect. So it's weird, but China's aggressive selling could potentially increase demand for the very dollars in treasury bonds they're trying to dump. It could partly counteract their own selling pressure.
That's fascinating. A financial boomerang effect. Okay, so maybe not financial Armageddon for the U.S., but what about China? What happens to them if they pull this trigger? Oh, the costs for China would likely be immediate, severe, and potentially catastrophic for their own system.
How so?
Well, first, huge financial losses. They'd be triggering a fire sale and then selling their own assets into that depressed market, selling low after they caused the price drop.
Doesn't sound smart.
Not exactly a winning financial move. Second, remember why they hold dollars. To manage their currency.
Right, keep the renminbi competitive for exports.
If they dump dollars, the dollar likely weakens, meaning the renminbi could appreciate sharply, maybe uncontrollably. That slams the brakes on their export machine. Huge damage to their core economic engine.
Ouch. A major blow to growth.
A huge blow. And it gets worse. Think about confidence.
Confidence.
If Beijing makes such a drastic, destabilizing move, what do you think domestic Chinese savers and international investors might do?
Get nervous. Pull their money out.
Exactly. You risk triggering massive capital flight out of China, people fearing more unpredictable actions, trying to get their money somewhere safer. That puts enormous strain on their own financial system.
So they risk their own citizens and investors panicking.
Precisely. Then there's inflation risk within China.
How does that work?
A weaker dollar makes imports more expensive for them, especially things like oil, food, commodities, which are mostly priced in dollars globally. Higher import costs mean higher domestic inflation. That can lead to social discontent.
Okay, so financial losses, export damage, capital flight, inflation, anything else?
Just the small matter of their international reputation. Such an aggressive, hostile financial act would cause severe, long-lasting damage to China's diplomatic standing and its image as a reliable economic partner. Trust would evaporate.
It really sounds like this financial nuclear option is more like a financial self-destruct button for Beijing.
That's a very good way to put it. The downside for them is immense and arguably much more certain than the damage they could inflict on the U.S.
Now, the report also mentioned equities, U.S. stocks. What about forcing a sell-off there? Is that feasible?
That one's even more far-fetched, frankly. More complex, even less practical.
Why? Don't they own U.S. stocks?
They do, but tracking it all is the first hurdle. Official data on direct holdings is pretty modest. Estimates that try to include indirect holdings, maybe through Hong Kong, complex structures like VIEs, suggest it could be in the hundreds of billions, maybe $700 billion at its peak. Probably less now.
Okay, still a lot. but hard to track.
Incredibly hard. These holdings are spread across countless different state funds, companies, maybe even individuals using intricate ownership structures. Just identifying who owns what definitively to force a sale, that's an operational nightmare. The report even mentions ideas like treason charges that tells you the extreme level of coercion needed, which seems unlikely.
A logistical nightmare just to find the shares.
Exactly. And let's say, hypothetically, they could identify them and could force a sale. What happens?
Market panic. Fire sale.
Precisely. It triggers panic, prices plummet, and they destroy the value of the very assets they're trying to weaponize, inflicting massive losses on their own Chinese entities.
Another self-inflicted one.
And think about investor confidence again. If China starts forcibly liquidating assets held by its entities abroad,
It sends a terrible signal.
a terrible signal. It would shatter confidence, potentially leading to an even broader capital exodus from China itself. Investors would flee.
And surely the U.S. wouldn't just stand by.
Highly improbable. You'd expect swift and severe U.S. countermeasures, asset freezes, sanctions targeting Chinese banks involved, maybe even accelerating the delisting of Chinese companies from U.S. exchanges.
So yeah, a lose-lose-lose scenario on the equity front too. Seems like a non-starter.
Pretty much.
Okay, let's shift back to the big picture. The U.S. dollar itself. Even if China did somehow manage to sell a huge chunk of bonds, could that actually knock the dollar off its perch as the world's main currency?
That's the multi-trillion-dollar question, isn't it? And the analysis suggests probably not, at least not quickly.
Why not?
It comes down to just how deeply embedded the dollar is in the global system. There are fundamental reasons for its dominance.
Like what?
The sheer size and underlying stability of the U.S. economy, for one. Then there's the unmatched depth and liquidity of U.S. financial markets. You can buy and sell huge amounts easily.
Okay.
Plus the rule of law, strong institutions. And then there are network effects. Everyone uses it because everyone else uses it. For trade, for finance, and simple inertia. The whole global financial plumbing is built around the dollar.
It's like the default global operating system. Hard to replace overnight.
Very hard. And a key practical problem for China, if they sold trillions of dollars worth of assets, is where do they put the money?
Good question. What are the alternatives?
Well, there aren't many markets capable of absorbing that kind of inflow without causing massive distortions themselves. The Eurozone, Japan, even China's own market. They just don't have the same scale, depth, and ease of transaction as the U.S. markets.
Right. And what about their own currency, the renminbi? Could China just decide to hold its reserves in RMB? Could it become the new global standard?
Not easily. Not in its current state. The renminbi faces some pretty significant hurdles to becoming a true global reserve currency.
Like the fact that it's not freely traded.
That's the biggest one. Capital controls. China restricts the flow of money in and out of the country. Global reserve currencies generally need to be fully convertible, freely usable across borders.
Okay, what else?
They also have a managed exchange rate, not fully market determined. Their financial markets, while growing, are still less developed, less transparent than those in the U.S. or Europe. And there are, geopolitical trust factors too.
So even though China's promoting the RMB.
Yeah, they're definitely pushing for more international use settling trade in RMB, currency swap lines, developing their own payment systems like CIPS, the digital yuan.
But it's still a small player globally.
Relatively small in terms of global reserves, maybe 2.53% currently, and in global payments, maybe 4-8%, depending on how you measure. It's growing, but it's a long way from challenging the dollar's dominance.
There's that economics concept too, isn't there? The impossible trinity.
Ah, yes. Good point. The impossible trinity basically says a country can't easily have all three of these things at once. A fixed or managed exchange rate, free movement of capital, and an independent monetary policy, like setting its own interest rates.
You'll have to choose.
You generally have to choose 2 out of 3. China has prioritized managing its exchange rate and having control over its monetary policy. That necessitates maintaining some capital controls.
And those capital controls limit the RMB's appeal as a global reserve currency.
Exactly. It makes it harder for international investors to move money in and out freely, which is crucial for a reserve currency. So China's efforts to internationalize the RMB look less like an immediate plan to replace the dollar and more like a long-term strategy for diversification.
Diversification and maybe reducing their vulnerability, like to U.S. sanctions.
Precisely. It's more about building resilience, creating alternatives, making themselves less vulnerable to the dollar system over the long haul, a defensive play, rather than an imminent offensive one aimed at toppling the dollar.
Okay, so putting it all together, it really sounds like this whole financial nuclear option idea. It's more like mutually assured financial destruction.
That's a very accurate way to frame it, based on this analysis. MAD, Financial Edition. The report strongly suggests that triggering this would likely harm China far more reliably and perhaps more severely than it would harm the U.S.
And given that the Chinese leadership prioritizes stability.
Above almost everything else, domestic political control hinges on economic stability and continued growth. Why would they intentionally detonate a bomb under their own economy? It runs counter to their core interests.
It just doesn't seem rational.
Exactly. Using such an extreme, self-damaging tool over typical political friction or trade spats seems strategically illogical, wildly disproportionate.
So those rumors we sometimes hear about China preparing for austerity or quietly selling assets.
The analysis suggests those are much more likely interpreted as defensive maneuvers, maybe hedging against perceived U.S. pressure or gradual diversification rather than gearing up for an all-out financial assault.
Okay, so let's try and summarize the main takeaway here. This idea, this financial nuke, it makes for dramatic headlines, right?
Definitely grabs attention.
But when you dig into the economic realities, the market structures, the potential for massive self-harm for China, it seems like an incredibly low probability event.
That's the strong conclusion from the analysis, yes.
Yeah.
Extremely low probability. The U.S. financial system has buffers, the Fed has tools, and the dollar's position is just incredibly entrenched.
And the costs for China are just too high.
Prohibitively high, most likely.
It's good to get that clarity. By doing this deep dive, looking at the detailed analysis, hopefully our listeners now have a much more nuanced view than just the scary headlines.
That's the goal, moving beyond the hype to the underlying mechanics.
Absolutely. So here's a final thought then, something to mull over. If this really dramatic nuclear option is pretty much off the table, what should we be watching instead? What are the more likely, maybe more subtle ways global economic power might shift in the years ahead?
That's a great question. Maybe it's about that gradual, slow-burn de-dollarization in certain trade blocs.
Or the steady development of those alternative payment systems you mentioned. CIPS, digital currency.
Exactly. Or just the ongoing, everyday geopolitical competition playing out through trade policy, technology standards, investment flows. Less explosive, perhaps, but still profoundly shaping the future.
Definitely gives you something more realistic, maybe, to think about and track going forward.